Is a Fed cut and more market exuberance all but guaranteed? Tim?
Well, we've priced in a lot of market exuberance, and really, even after the V-shaped recovery from Liberation Day, we've done, probably almost 10% on the S&P, almost 12% on the Nasdaq, and it's interesting. You're talking about the Dow today. We kind of sometimes make fun of the Dow as an index because we think it's the way it's calculated makes less sense to me. That's not what we're here to talk about. The point is that small caps, equal weighted, Dow, so not semis, not the high end of the tech outperformed today on this sense that you really got reaffirmation from some of the data. The data being a bizarre jobless claims number. Excited to talk to Rick Santelli and get his interpretation of some of that. But I don't think today's CPI was a great number if you're someone that wants to see inflation tamed. I mean, I think we actually saw some goods inflation that's seeping through. I think we know that services inflation is sticky. I think we have a higher kind of inflation paradigm right now, better than at least higher than where the Fed wants to be. And I think all the liquidity to have markets going to the moon right now, and that's almost every market, especially even credit, is something that should give the Fed some pause, even though the labor side of the mandate, we all know, is getting all the attention right now. So markets have priced in a lot of Fed. I think markets have priced in more than the Fed that we now have in terms of Fed fund futures. And I think that's something to be somewhat wary of. But what a week when you think of all the earnings revisions, I think, that are coming for the tech sector based upon all the news we've had over the last 5 days.
I mean, I think the question at this point is are the markets pricing in too much Fed? I mean, you take a look at the inflation numbers. Are you somebody out there who buys groceries, gasoline, electricity, and repairs your car?
Yep.
Well, then you see inflation, and that's an issue. I mean, that's a problem for the Fed.
It's a problem. I mean, the macro is about as confusing as it's been in a very long time. You look at that June jobs report that's been revised lower. That was the first one, I think, since COVID, right? And then if you look at the CPI and you look at some of these other inflation readings, you have to kind of take into account, like, the cumulative nature of, this inflation is the thing. So if you have a weakening jobs market and you have inflation starting to move higher, that's a really tough spot for a consumer that is already dealing with some of these increased prices as it relates to the tariffs and the uncertainty and how long we're going to actually be in a trade war. I mean, you got to think about this. We came into this year, it was 2.5%, basically that tax across the board. And here we are, it's about 18%. So the, as it relates to the market, though, I think, Tim, what he just said is, like, there's one thing, though, that's actually working in the stock market in the S&P 500's favor is that we see the dollar can't get out of its own way. And this whole notion that we're going to be in a rate cutting cycle, that should be a bit of a tailwind. And then you just kind of throw in this CapEx that we've seen, again and again and again. The numbers are so huge. And I think it was Apollo's Torsten Slok had this slide last week, and I think we talked about it 2 weeks ago. If the consumer's 2/3 of GDP, right? Well, that CapEx has just matched that number. So that's been a huge, huge tailwind. So if you do start to see a pullback in that and a weakening consumer, there's little doubt that you're going to be in a situation where it's going to start getting back to that R-word recession. We haven't heard that in a very long time.
I go a different angle. I go jobless claims. So jobless claims the worst in 4 years since October 2021. If you have a job, you can pay inflationary prices. Shelter costs, 1/3 of the CPI. Think about the chicken and the egg. If the Fed lowers rates, you wind up having lower mortgage rates. You wind up having lower CPI. Right? So for me, they're enforcing that higher CPI by not cutting rates. So if you could cut rates, 1/3 of CPI comes down. 1/3 of CPI comes down. Then you throw in transportation. You have gas coming down, used car prices. Why aren't used car prices moving down? Interest rates. So you have mortgage rates, interest rates for used car prices. Everything that the Fed is doing is fostering higher prices by keeping prices where they are right now. So double mandate, I'm looking at the job side more importantly.